Hi everyone, welcome to Accounting Explained. This is the second video in our accounting concept series. If you are new here, I am Zan, a qualified accountant. And today we are diving into the basics of accounting in a fun and easy way. Whether you are an entrepreneur thinking about starting a new business or an accounting student, this video is perfect for you. By the end of this video, you will understand essential accounting principles, key accounting terminologies, and the accounting cycle from the first transaction to finalizing financial statements. I'll walk you through the entire accounting process using a simple example of a small business, so you can see how it all fits together. If you're looking for specific information, check out the timestamps in the video description to jump straight to what you need. But I recommend watching the whole video to get the most out of it. Alright, without further ado, let's get started. After working as an accountant for the last decade, let me first tell you what I think accounting is in a nutshell. Accounting is the process of keeping track of your money and stuff, which helps you to know how much you have, how much you get, and how much you spend, so that you can make sensible business decisions. This is a simple definition to build an overall understanding, but let's look at the standard definition. Accounting is the process of recording, summarizing, and reporting financial transactions to communicate useful and reliable information to all interested parties. I know this sounds very complicated, but don't worry. I will break it down into 4 easy steps and it will be crystal clear. Notice there is one word common in both definitions: process. This shows that accounting is a process. If you understand the accounting process, you won't have to remember the definition. How cool is that? So let's break down the accounting definition into a process diagram. It will look like this: recording, summarizing, reporting, and finally, communicating. We first have to record financial transactions, then summarize them in a useful way, put these into a report format, and finally share the reports with those who need them. We are going to delve into each of these steps, and once you understand these 4 steps of accounting, you will know exactly what accounting is, how it is done, and how it can help a business. But before I explain this 4-step accounting process, let's take a step back. This is the right time for you to quickly familiarize yourself with some basic accounting terminologies that are important to understand. Let's look at some key terminologies in accounting. First one we have is assets. Assets are any resources that a business owns or controls, such as cars, buildings, cash, etc. Then we have liabilities. Liabilities are any financial obligation that a business have to pay, such as a loan from a bank. The third one that you should know is equity. It is also known as owner's equity or capital. They're all the same. This is the value of what the owners owns in a business after all debts are paid. It's like the owner's share of the business. Because in a business, you sometimes use other people's money to run it. So that money is not part of your equity. It is a liability. Makes sense, right? Then we have revenue, also known as sales. It is the money a business earns from selling goods or services. And finally, we have expenses. An expense is the money a business spends to run its operations, such as material costs or electricity bills, for example. There are some important interconnections between these terminologies. For example, assets are always equal to liabilities plus owner's equity. This is called accounting equation, and it is one of the fundamental principles of accounting. If you don't fully understand this, don't worry, I've got you covered. Keep watching the video and you will understand what accounting equation is, or if you need a deeper understanding, you can watch my separate video that I have done on accounting equation on this channel. Another interconnection you should know is between equity, revenue, and expense. Think of these 3 like cousins. Put simply, Revenue increases equity and expenses decrease equity. The idea is straightforward. If you make money, your equity in the business goes up, and if you spend money, it goes down. It's all common sense behind these intimidating technical words. Now that you know these 5 key accounting terminologies, let's quickly look at the two most important terms, debit and credit, and their relationship with these 5 terminologies. Debit and credit are a mechanism of recording financial transactions, and every debit must have an equal credit entry. Think of these like the rules of a game. When we play any game, there are some rules everyone must follow, and the same is true for debit and credit in accounting. To remember the rules of debit and credit, we need to look at the accounting equation. The accounting equation is assets are always equal to liabilities plus owner's equity. The rule to keep in mind is this. The items on the left side of the equation are debit in nature, and the items on the right side of the equation are credit in nature. The total of both debits and credits will always be equal. Remember, debits are always on the left side and credits are always on the right side. Let's look at each terminology you have learned and their nature. The nature of asset is debit, the nature of liability is credit, the nature of equity is credit, the nature of revenue is credit, and the nature of expense is debit. Let me explain what nature means here. Nature is like DNA. It cannot be changed. Remember the rules of the game? These are the rules of accounting. Let us look at how each of these items increase or decrease. If we want to increase an asset, it will be debited, and if we want to decrease it, it will be credited. If we want to increase a liability, equity, or revenue, these will be credited because their nature is credit. But if we want to decrease them, these will be debited. Finally, an increase in expense is a debit and a decrease is a credit. I know it might be overwhelming for you at first, but trust me, if you remember the nature of each of these, you will never forget whether to debit it or credit it. Just remember the nature and it will become second nature of whether to debit or credit anything. Trust me on this one. Before we move on, you might be wondering about revenue and expense since they aren't explicitly part of the accounting equation. Actually, they are part of the accounting equation because profit is calculated by deducting expenses from revenue, and this profit ultimately becomes part of the owner's equity. Remember I said earlier that equity, revenue, and expense are like cousins? If revenue increases, it can increase equity. That is why both equity and revenue have a credit nature. Expense, on the other hand, decreases equity, and therefore it has an opposite debit nature. Feel free to pause the video and take a minute to memorize these rules. I know it's a lot to take in, but it will get easier from here, I promise. Alright, now that you understand the important terminologies and their nature, let's go back to the 4-step accounting process to understand what accounting is and how it is done. The first accounting step is recording. Recording is the process of documenting all financial transactions of a business. This step ensures that every transaction is captured accurately and chronologically. Let's understand recording through an easy example. Sarah and Mike both work full-time, but dream of escaping the 9-to-5 routine like most of us to achieve financial freedom by running their own business. So they started a side hustle of selling art and crafts products online on a Facebook page called SM Arts. At the beginning of this business, they invested $1,000 into it. They spent $500 on business expenses and made sales of $700 in their first month of trading. Sarah and Mike have no clue how to record these transactions, so they asked for our help to do the accounting for them. Let's record these transactions. To record these transactions, we will post journal entries. A journal entry is simply a way of recording debits and credits. In the real world, we will pass these entries in a software or a spreadsheet. The first entry is for initial investment. As the business has received $1,000 from the owners, we will debit the cash account by $1,000 because cash is increasing, and credit equity by 1000 because equity is also increasing. The second entry is expenses incurred. We would debit expenses by $500 and we will credit cash by 500 because cash is going down. The final entry is for revenue. We will debit the cash by $700 as we have received it and credit revenue by the same amount as revenue has also increased. Let's calculate the total for each account. Cash is at $1,200, equity is at $1,000, expense is at $500, and revenue is at $700. Here, the first step of recording transactions is done. We have recorded all the transactions. Let's move on to step 2, summarizing. Summarizing involves consolidating all the recorded transactions in a way that ensures all debits equal total credits. This is achieved by preparing something called a trial balance, which lists all accounts with their closing balances. Let's prepare the trial balance for SMRs so you can understand it. If I zoom out a little bit, you can see from our journal entries the closing balances for each account. We will simply transfer these balances here in the trial balance. So cash is at $1,200 on the debit side, equity on the credit side $1,000, expenses on the debit side $500, and revenue on the credit side $700. As you can see, both the debit and credit sides of the trial balance for SMRs are equal at $1,700. The second step is now done, and let's move on to the third step, which is reporting. Reporting involves presenting the summarized financial data in structured reports that provide insight into the financial performance and position of the business. There are 3 key reports that we need to prepare for SMRs: the income statement, also known as profit and loss account, the balance sheet, and the cash flow statement. Income statement shows the company's revenue and expenses over a specific period, resulting in net profit or loss. Balance sheet provides a snapshot of the company's assets, liabilities, and equity at a specific point in time, illustrating the financial position. And cash flow statement reports the cash inflows and outflows over a period, highlighting the company's liquidity and cash position. For SMRs, let's prepare their income statement at the end of month 1. So an income statement looks like this. We have revenue, we have cost of goods sold, which we deduct from the revenue and arrive at gross profit. Then we deduct operating expenses, and finally we have a net profit. The cost of goods sold includes direct costs like materials or labor, which are directly related to producing goods or directly related to your main product. Operating expenses, on the other hand, are indirect costs which cannot be directly linked to the production of the goods or the goods themselves, such as electricity bills. So the revenue was $700. Cost of goods sold, we will assume, is $400 out of the total of $500. Then we arrive at a gross profit of $300. The operating expenses is the remaining $100 out of the total of $500. And the net profit, we arrive at $200. The income statement nicely summarizes SMR's financial performance for the first month of their trading. Let's quickly prepare the balance sheet. The balance sheet would always start from assets, then liabilities and equity. Remember the accounting equation? It is the same. Cash is the only asset currently, with a closing balance of $1,200, so we have added it under assets. There are no liabilities reported, so nil. The beginning balance of equity was $1,000. After earning a net profit of $200, as we calculated in the income statement, the total equity at the end of month 1 is $1,200. As we can see, both sides of the balance sheet equal $1,200, demonstrating that the accounting equation holds true. Now let's prepare the last statement, the cash flow statement, using the direct method. The direct method is straightforward. We simply add inflows and subtract outflows. There is another method of preparing the cash flow statement that's more complex, which I will cover in a future video. For now, let's stick to the direct method. Initially, the cash balance was $1,000. The first and only outflow was $500 for expenses, which we deduct. Additionally, the business generated $700 from cash sales, which we add. This gives us a closing balance of $1,200, which matches with the balance sheet as you can see. We have prepared all three financial statements for SMRs, and this concludes the third step of the accounting process. Let's look at the final fourth step, communicating. Communicating involves sharing the financial reports with stakeholders to provide transparency and facilitate informed decision making. There are two types of users for financial statements, internal and external stakeholders. Internal stakeholders include management like Sarah and Mike, employees, the board of directors. They will use financial reports to make operational, strategic, and investment decisions. External stakeholders, on the other hand, include investors, banks, regulators, and shareholders. They need accurate financial information to assess the company's performance and stability. By preparing the financial statements, Sarah and Mike got a pretty good understanding of the financial health of their business. Let's do a quick recap of what we have learned. Accounting starts with recording, summarizing, reporting, and finally, communicating. Before you go, I have a small accounting quiz for you. If you dab it the like and subscribe button on this video, what will be credited? Leave a comment to give your answer. I will be waiting. Moreover, if you have any question about any accounting related area, feel free to leave a comment and I promise I will get back to you. Thanks for watching. Until next time, bye bye.